a difference a decade makes. 2008, we were worried about the actual viability of the financial system. And today, we're talking about an economy that is roaring. Small business optimism that's higher than it's been in decades. The money is flowing. The taxes have been cut. Regulations are being cut. What could go wrong?
What could possibly go wrong?
What could go wrong, Lloyd Blankfein?
I haven't felt this way. I haven't felt this good since 2006.
Yeah, that's not what I want
exactly.
to hear.
Well, that's true. You have to have that in mind.
Is there a risk of overheating here?
You know, of course there is. I would say the conditions are not just benign. They're very highly supportive of a good economy. The economy was good before. On top of it, we put in $1.5 trillion of tax cuts, $300 billion of spending over additional spending, maybe even an infrastructure bill.
Right.
And so the sentiment is very positive, and interest rates are relatively low for where we are in the growth cycle. The issue could be potentially, I'm not saying this is certainly not my base case, but I'm in the business of worrying about small but adverse probabilities, is too much of a good thing. If the economy starts to overheat and the Fed feels it's behind, you know, the market's saying, gosh, could the Fed raise twice? Can they raise 3 times, maybe 4 times in this year? Well, guess what? I remember 1994 where the Fed was raising in between meetings, raised 75 basis points, 100 basis points at a pop. So that's possible, too, and that would be quite jarring to the economy.
$1.1 trillion deficits in a Republican president and a Republican administration. When Barack Obama did this, it was like the enemy of the economy.
Listen, I'm not making a statement here because both parties have taken their turn at stretching the budget deficit to new levels.
Right.
But by the way, these aren't crazy people. There's a point of view on the other side, which is that the economy, even at this level of growth, hasn't achieved its potential.
Right.
Some people argue with that, but then again, the economy has been growing faster and faster. We're close to 3% growth, and people there are saying it can go further. A lot of economists say they can't. If the economy does grow faster, you know, there's the basic supply side. You know, GDP goes up, earnings go up, tax revenue goes up, and maybe part of it will pay for itself. I think it's optimistic. It's not impossible. But I'm in the world of contingency planning for risks. And I would say that the odds of a bad outcome have gone up. Right. I wouldn't say that's my case. That's not my best case. But the idea that the Fed is behind, don't forget, all these deficits have to be paid for, so there are going to be more treasuries that are going to have to be issued than there were before, and they have a competitor, the central bank, which has to get rid of its inventory of treasuries, and they're going to sell into the same kind of market to the same investors. Someone might stay there and say, gee, am I going to really lend to the U.S. government for 10 years at 2.8% when historically 10-year rate was much higher?
Right.
Maybe not for 10 years. And that's what, by the way, where the recent volatility
in the stock market
has come from, which is, my God, what is the potential for a kind of a shock? And it's not more likely than not, but the odds of it have gone up a bit.
So that stock market event of the past couple of weeks, was that a bubble? Did it pop, or are we the beginning of something, a new reckoning that an era of higher interest rates is coming and the ultra low rates?
I would say the one
over?
funny thing for someone who's been in the markets for 35, 36 years, that's really a surprise to me, is kind of the unanimity of view. How many pundits have you heard saying, buckle up, we're going to keep going, as opposed to people saying it's highly technical. You know something? We needed this. This is good. The market needed this move down, and it's coming, and it's coming back. There's a lot of surprises in the world. Haven't we been living them? Surprises. And so, I don't know, I can give you a scenario where maybe if everybody's a little bit too complacent, a little bit too optimistic. Not my base case, but that's what we have to reckon. Again, I'm in the world of not relying on forecasts. I'm in the world of contingency planning. I have to make sure, not that I guess the future, but that I react more quickly to the present than other people.
What do you say to regular investors, people who aren't bankers at Goldman Sachs or don't have, are clients of Goldman Sachs, but regular Americans who are watching the stock market?
At this particular time, I would say, don't throw all in. You know, people are saying, gosh, you should buy more at the lows. Yeah, if you're really rich and you have a lot of excess capital. But I wouldn't throw all in. I'd be planning for the contingency that this turns out to be a worse type that people are thinking. I wouldn't be more audacious today with the Fed on a raising rate, with the withdrawal of QE, with the budget deficit widening out. I wouldn't say this is the time I would max out on my risk as opposed to a year ago.